Awesome.
So welcome to the attendees, and thank you to Zack, Danielle, and Susan also for being here. I'll let you introduce yourself and just start talking about it. Susan.
So I'm Susan Malloy of the Malloy team. And we often do these first-time home buyers workshops. We have the pleasure of being with Zack and Danielle today, who are awesome. You will have a great time, and they'll make it seem like a really easy process, which is great. And Sebastiano put this together for us, which is great. I have not done a Zoom one yet, so this will be a lot of fun. So I will let Zack, who's from Citibank, and Danielle, who's with Kraus Legal, introduce themselves. And enjoy yourselves today. Ask a lot of questions.
Thank you very much, Susan. I'm Zack. I'm a mortgage banker from Citibank. I've been working with Citibank for about 4 years, and I've been working in the mortgage industry for 10 years, this month actually. Susan and I have done a lot of work together. We have lots of experience with each other, and we work very, very well with one another. And I've also done a lot of work with Danielle as well, who's here, who's incredible. I highly recommend her. She's great as well. I'll pass it over to Danielle to say hi.
All right, hi guys. So my name is Danielle Spallino. I'm with a firm called Kraus Legal. And so we are residential real estate attorneys. And what that means is we represent, individuals like you all, purchasing and selling their properties. We deal with a lot of first-time home buyers. So we're very used to walking our clients through, kind of doing a lot of hand-holding. I always say it's very important to put together, a good team and to help you through your transaction. And the people here, like Zack has said, we've worked together many times, and these professionals are great. They know exactly what they're doing, and putting together a team of broker, banker, and attorney is essential for you to, have a smooth transaction.
Thank you, Zack. Thank you, Danielle. I think we can start talking about the questions we have already from our from my clients. So let's start talking about what should come first, the property or the mortgage, Zack.
Sure. So at the very beginning of the process, if you're looking to get a mortgage, which is a loan, what you need to do is you need to get pre-approved. And what this means is you talk to somebody like myself, you talk to a bank, and we go over your finances and we make sure, in essence, that you can afford whatever it is that you're looking for. And in simplest terms, what that means is we're looking at something called your debt to income ratio, which is on a monthly basis, how much you spend as a percentage of how much it is that you earn. So if you make $10,000 a month and you're going to be spending $4,000 a month, your debt to income ratio is 40%. You're spending 40% of what it is that you're earning. And in general, very generally speaking, a bank wants to see that you're at 43% or less. So if you are less than 43%, you're very likely going to be approved for a mortgage. If you're over 43%, you're very likely not going to be approved for a mortgage. And specifically what we're looking at when it comes to that 43% is your mortgage payment itself, any other kind of housing expenses associated with your home. So that would be things like common charges if you're purchasing a condo, or maintenance fees if you're purchasing a co-op, property taxes, property insurance, any cool stuff like that. And lastly, we want to make sure that any other monthly debts that you have, such as credit card debt, student loan debt, car loans, or car leases, that all of those payments together are still going to be less than 43%. And that's in essence the entire mortgage process of what it is that we're looking for. I also pull your credit and make sure that everything looks good there. The entire pre-approval process typically takes around 15 minutes or so on the phone. And during that time, I can identify if there are any potential issues with somebody getting a mortgage. Last thing I'll say is for self-employed individuals, it's also very important that I'm looking at your tax returns, because if you're self-employed, your income by its very nature is expected to change. So I take a look at what your tax returns look like for the last 2 years and try to get a better understanding of what your income is going to look like in the future. So if you're self-employed, if you're an actor maybe that has lots of different W-2s, lots of different projects that you're working on, I'll talk to you all about that. And that's in essence the mortgage approval process.
Thank you, Zach. I wanted to ask to Danielle, why do people need an attorney when they buy their first home, and when they need the attorney?
Okay, so I highly recommend that you get an attorney. In New York, we always say that you're supposed to have one. I've known a few people who've self-represented. It's never really a good idea. Purchasing is a complex process. It can get quite emotional, and you want to have a legal representative to protect you when it comes time to sign the contract. So again, back to setting up your team. You obviously will have your real estate broker. You'll speak to your mortgage banker like Zack in the very beginning, and you should start having conversations with potential real estate attorneys, when you're getting serious about putting offers in. Once you do put an offer in and it's accepted, things move very fast. So you want to know who you're going to be working with instead of rushing once your offer has been accepted to just find an attorney. You really want to make sure you've had the time to call a few and vet them and see who you feel most comfortable with.
Thank you, Danielle. Also, another question that I have a lot is, how do I know how much I can afford?
Yeah, so there are two kind of questions in there. One is, I would say, how much can I afford, which is going to be different than how much do I qualify for. As a bank, I'm very good at telling you how much it is that you'd qualify for. I can let you know exactly what a bank would or would not give to you. How much can you afford is, I think it's kind of more of a personal decision for you. What do you feel comfortable spending every month? In general, a really easy rule of thumb is for every $500 that you want to spend on your mortgage, that's the equivalent of around $100,000 of a mortgage loan. So if you know that you want to spend $2,000 on your mortgage, for example, $2,000 would be equivalent to around a $400,000 mortgage loan. And that can give you a general idea of what it is that you'd be spending. But how much it is that you can afford is really going to be a decision up to you of what you feel comfortable spending, as long as it's underneath what you'd actually qualify for.
Awesome. And connected to these, if I receive a gift from my parent, more for Danielle probably, how that impacts me tax-wise, or what should I consider if my parents are helping me buy my place?
So I think that's actually more of a question for Zack and how it impacts financing. To be honest, on the legal side, it's fine. It happens so often. I work with so many people who are getting, gifts from their parents or family members to purchase, and that is totally fine. I can't really advise on tax situation because that's more for my accountant, but it's fine from a legal perspective, from a contract perspective, and you just need to work with your banker and your broker to structure the deal otherwise. So I'll defer to Zack on that.
Yeah, I agree completely with Danielle on that. On the banking side, it's perfectly fine. Banks are perfectly, it's very common actually, I'd say, for especially first-time home buyers to receive a gift of some sort. And it doesn't matter if it's a small portion of your down payment, or even if it's the entire amount of your down payment, that's perfectly fine. We don't report anything to the IRS. So if you're looking to get a gift, I always just recommend talking to your CPA and your financial advisor and seeing if that affects you. I don't want to give any kind of tax advice there, but from the banking side, it's perfectly fine getting a gift as well.
So related to this, how do I decide the down payment, the amount of the down payment?
I think that the market is going to dictate that for you, to be honest. When it comes to co-ops will limit the amount of financing, usually 80%, some 90%, some less, depending on what kind of building it is. But that's what it's going to dictate. Condos are a little less restrictive. So sometimes people finance 90%, but in New York, the standard really is 80 is, I would say 80% of the time people finance 80%, or in some, maybe another 10%, it's 90%. So you just have to work out the numbers and what you're comfortable with, really.
Yeah, going off of that, from the bank's perspective, banks are oftentimes a lot more relaxed when it comes to down payments than what the building itself would be. Citibank, the bank that I work for example, we're okay in some cases of somebody putting down even like a 5% down payment, depending on the exact situation, sometimes even like a 3% down payment. But regardless of what we're okay with, the building itself oftentimes will dictate the minimum amount that you have to put down. A lot of co-ops will require a 20% down payment. A lot of condos will require even like a 10% down payment. And then even then, regardless of if the building and the bank are okay with whatever your down payment is, a lot of times it's up to the seller, him or herself, whether they're going to accept whatever your down payment is or not, or whether they're going to look for an offer that might have a higher down payment.
Great. And now let's say we have an accepted offer. What happens for there? Can you tell our audience what happens from there?
Yeah, I think I'll start on this one. So once there's an accepted offer, like I said, things do move pretty quickly. So you need to have your attorney lined up. That's extremely important. Everyone will be asking you who's your attorney the day your offer is accepted, essentially. So you definitely want to have that in place. When your offer is accepted, a term sheet goes out just with basically memorializing who everyone is and what the terms of the transaction are. So your broker will have helped you with negotiating the price, whether or not there's a financing contingency, any special other conditions, and your attorneys on both sides need to know what those are to put them in a contract. Something that is very unique to New York City is the fact that we're dealing with co-ops and condos, and those they run like companies in the sense that they have audited financials, they have tons of building documents, rules, protocols. So in addition to your attorney negotiating the contract, they're also going to be doing what we call due diligence, which is reviewing all of those building documents and reporting back to you what they found or what I found, and explaining to you how that compares to what we see normally in similar size buildings and similar types of buildings, whether it's a co-op or condo. And then during that time, I'm always making sure that the client is speaking with a banker, like Zack. And it's super important that people are working with a local banker. And Zack, I'm sure, can go into the importance of that. But working with someone who's not local to the area can really be detrimental to your transaction.
Yeah, if I can jump on that, I would love for you guys to use me as your banker. If you're not using me as your banker, I would just really hope that you're calling a local banker, like Danielle said, that's local to New York, that works and does New York City real estate all the time. Danielle had said that New York is very unique, which is definitely true, that there are things that happen in New York that don't happen elsewhere. For example, and Danielle will know this one exactly, sometimes you might be buying the unit next door to where you are right now. You might be wanting to combine your units. And that's something that's very unique to New York. And if you're calling a 1-800 number for whoever happens to pick up the phone, that might be based out of like Missouri or North Dakota or South Dakota, they might not have lots of experience with co-ops. Whereas if you were to ask Danielle, hey, I work with ABC Bank, do you know somebody that works with ABC Bank? Or your real estate agent, they're absolutely going to know somebody that works at the bank that you want to be working with, and can connect you with an actual human that works for that bank in New York and has the experience here. Similarly to that, when you're looking for an attorney, my cat's trying to get on screen now, so I'm pushing her away. But when you're looking for an attorney, definitely use Danielle, use a local attorney, because even if you're using a New York State attorney, they might not have the experience of doing real estate in New York City, which is very, very unique. So it's one of those cases where they're not going to know what they don't know. And it's important that you're working with somebody that does know what they need to know. I'll just kind of say that, and I can pass it back to you.
Yes, thank you. That's very important because that's a question that I didn't receive now, but a client of mine lives in California and he wants to do an investment. And he asked me, may I use people from California? And I think he might better consider people from New York, right?
Yeah, definitely. I mean, he can use somebody from California. There's nothing going to stop him from using somebody in California. But if I were in his shoes, I would absolutely want to use a New York-based attorney, a New York-based banker, and a New York-based real estate agent.
Thank you. I have another question here. Okay, what happens if we've gone through the process and the mortgage gets denied after?
Okay, so that happens. So it's important if you are financing to discuss with Sebastiano and Susan how you're going to structure the contract when it comes to financing. So most of the time deals are contingent on financing. So what that means is if the bank cannot lend to you for any reason, whether it's to you personally because of some issue with your finances or because they can't lend in the building, they have to do a kind of audit of the building itself and look at their financials and make sure they're sound. Or if the appraisal has an issue, you will be protected. So under all three of those scenarios, you would get your money back if you were denied for financing.
Yeah, no, and my follow-up question is about the building. How much do you look into that? And more to Zack, how much that you look into that as well, right?
Yeah, so I would say even when you're about to make an offer on a building, definitely reach out to me and ask, hey, can you take a look at this building? Does everything look good in this building? We keep a database of all buildings that we've lent in. We keep a database of all of those financials from the building. So I can let you know if you reach out to me, yes, we've recently lent in this building, everything there looks fine. Or, hey, we've recently reviewed this building and there was this issue. For example, it might be that there are really high rental concentrations in the building, that if you were to buy in the building, you'd be one of the only owners, which isn't a great thing from a lending perspective if there are a lot of renters in the building. It might be something like half of the units are owned by an individual. So if that individual were to have financial difficulties, the entire building could financially collapse. I can let you know of any sort of issues of those. And the strange thing is, regardless of how strong you are financially, if the building isn't also financially sound, you won't be able to get financing in the building. So you could be the best borrower in the entire world, but if the building isn't a financially strong building, you're not going to be able to get a mortgage, unfortunately, in the building.
And what should I consider as closing costs, generally speaking, because we know it change case by case, but.
So on that, what I do for each of my clients, I'm sure Zack does something similar as well, but I provide a closing cost estimate. So there are two large differences between co-ops and condos, right? So, depending on what you're looking for, your closing costs will differ drastically. In a co-op, you're not buying what we call real property, like land or a house in the sense of the word. You're actually buying shares in a corporation. So you don't pay a lot of things like mortgage recording tax, which is a significant number. You're not getting title insurance. So your fees are more based around the co-op application fees, the co-op closing fees. You have your attorney fees, some move-in fees, and something called a lien search, which is less than $500. On the condo side, it's real property. You get a deed, which is obviously different than the co-op shares. So you are going to have more closing expenses. Again, you need to buy a title insurance policy to protect yourself. You need to pay mortgage recording tax to the state as for the privilege of getting a mortgage and recording that. And so it's a bit more significant, and it's important to have a conversation with both your real estate agent and your banker before to see how that's going to impact what you can afford, going back to one of the earlier questions.
Yeah, good news that I would say too is that regardless of what bank it is that you decide to move forward with, the closing costs themselves don't really matter based off of what bank it is that you're looking for. All banks will have their own bank fees, which are usually within a few $100s of one another. The largest portion of the closing costs are going to actually be the mortgage tax that Danielle was just talking about. Depending on the property type, the property size rather, there's something called a mansion tax, which is a large portion of closing costs, and then title fees. And all of those things really are not going to vary pretty much at all, depending on how it is that you're deciding to purchase the property. So that's good news. It used to be that by picking a bank, your closing costs could vary a lot, and that's no longer the case.
Well, I have another question for you, Zack. Yes, what are the different, I know it's another broad question, types of mortgages available, but just a quick overview.
Yeah, so in essence, you have a choice between two different kinds of mortgages. One is called a fixed rate mortgage, where your rate is fixed and it's never going to change, which means that your mortgage payment itself is never going to change over the life of the loan. The other kind of loan that you can get is something called an adjustable rate mortgage. Sometimes you'll see it listed as an ARM, or called an ARM. An adjustable rate mortgage, the rate, like the name makes it sound like, it changes. So it's only fixed for a short period of time, typically maybe like 5, 7, or 10 years. And then every year after that, the rate can and will change depending on what's happening in the market. So those are the two types. There's a fixed rate mortgage and then an adjustable rate mortgage.
Okay, and what happens when two people want to purchase a property? Maybe they're not married and they want to buy together.
Sure, so on the mortgage side of things, like I said before, we're looking at the debt to income ratio. So if there are two individuals, we're looking at their combined debt to income ratio. So that would be my partner and me, we add our income together. And then my partner and me also add our expenses together. And whatever our combined debt to income ratio is what the bank is using to decide if they're going to lend to those individuals or not. So it's sort of counterintuitive. Sometimes people make a strategic choice to not include somebody on the mortgage itself. If that person maybe doesn't have stable income and has high debts, sometimes that's a discussion to have with your banker about leaving that person off of the mortgage and only having one applicant that has perhaps like the stronger income and lower debts.
Danielle, anything?
Yeah, on my end, I mean, we see all different types of ownership, whether it's, you know, parent and child purchasing together, couples that are married or not married, or, you know, I've seen people buy a townhouse with as multiple units, two families literally buy together. So we just have a conversation about how you want to take ownership, and that, you know, it's kind of a deeper conversation, but it depends on you know, how you want, if God forbid someone were to pass away, how things would pass, and what's best for couples that are married or not married, and how we structure that. So it's just a conversation to have with your legal counsel prior to closing. But it can be, anything can be done.
And the people who own the home too, I can say this, don't necessarily need to be the same people that are on the mortgage loan itself. So I could be purchasing with my partner, and only I could be the owner of the property if that's something that we wanted to do. Or the opposite could be true. We could both be owners of the property. We could both be on the contract and the deed, but only maybe my partner is on the mortgage loan. So whoever's on the loan can be the same people who are on the deed, but it doesn't have to be that way.
Great. Since you're getting towards the end, I would ask both of you just what would be your general advice to our clients that are about to purchase their first home? Danielle?
Okay, I didn't know who was going to go first. I always, again, go back to having a confident team. All of us on this call, our teams have worked together. We know and we trust each other. And it's important for you to speak with people in advance to ensure that you are comfortable with them. Again, I go back to local New York council, local New York banker. New York is New York City for that matter is different from everywhere else. And it's really important for you to work with knowledgeable people. Just Zach was referring to a scenario before. I had a client working with Citibank, not with a New York banker. I had advised him not to do that on many occasions, but he felt really strongly about whoever he was using. He called me literally crying 2 weeks ago because the banker that was out of New York could not deal with what he was trying to do in a co-op. I called Zack and he not fixed it, but he was able to help him and will fix it before closing. So again, it's just one example of many about working with competent professionals in the New York City area. It's an emotional process. Try not to stress out too much. Trust your advisors. And I think that's the best advice I could give.
Yeah, my advice I think would be that I think the process moves both faster than you think it's going to be, and also at the same time, a lot more slowly than you think it's going to be. It happens a lot where a client will go out looking at homes, and then that day they find their dream home, they want to put in an offer, and they end up going into contract virtually immediately after that. So people who are prepared and have their pre-approval letter ready ahead of time are able to make offers right away, whereas somebody that hadn't thought about that before might not be able to do that. And then at the same time, I think the process moves a lot more slowly than people think because there are so many parties involved, especially if you're purchasing in a building. It's not just up to you and the bank whether you can purchase in the building. There's a co-op board potentially that's there as well. And Sebastiano is going to help you with your co-op board application. So just being prepared for things to kind of be like a relay race, I think, of where you hurry up and do your job, get everything that you need done to be finished, and then just be flexible and patient as the next person in line is doing their, processes, and then the next person after that.
So it's 4:30. So thank you, Zack. Thank you, Danielle. And thank you for everyone that was on the webinar. I'll share Zack and Danielle's email here and also after the panel. So if you have any specific question, you can ask them directly, because I was receiving some very specific question that I think they should ask you directly. And if anything comes after this panel, you should get in touch with them and ask for their advice. Thank you. Thank you, Zack. Thank you, Danielle.
Thank you so much for having us. And please feel free to reach out anytime with questions.
Thank you guys very much.
Bye.